In 2015, the Obama administration commissioned an independent study to find out whether financial advisors were actually helping or hurting the people who paid them. The findings were uncomfortable enough that the financial services industry spent over $50 million lobbying to suppress the rule changes that followed. The study found that conflicted financial advice shaped by the products that pay the advisor commissions rather than the products that are best for the client, costs American retirement savers approximately $17 billion per year, not in fees, in underperformance, in returns that are lower than they should be because the products recommended generate the most revenue for the advisor, not the most wealth for the client, $17 billion per year, quietly leaving the retirement accounts of ordinary Americans. Going into the pockets of an industry that is legally allowed, in most cases, to recommend products that are not in your best interest, as long as they are deemed suitable. Suitable is not the same as best, and the gap between suitable and best is where $17 billion a year disappears. Today, I want to tell you the 5 biggest lies that the financial advice industry tells retail investors. Not because all financial advisors are bad people. Many of them genuinely believe what they're saying. But the system they operate in has structural incentives that produce specific, predictable, documented patterns of misleading advice. And knowing those patterns is the difference between building wealth and subsidizing someone else's. Lie number 1, you need me to beat the market. The foundational pitch of the active financial management industry is that a skilled advisor or fund manager can identify investments that will outperform the market and deliver returns that justify their fees. This is the entire premise. Without this premise, there is no reason to pay for active management at all. Here is what the data says. The S&P Indices versus Active, or SPIVA, report is published twice a year and tracks how actively managed funds perform against their benchmark indices. The 2025 results. Over a 1-year period, 60% of large-cap active fund managers underperformed the S&P 500. Over 5 years, 78% underperformed. Over 15 years, 88% underperformed. Over 20 years, 95% underperformed. Not a small difference. A massive, consistent, compounding gap. And this is before fees. After the typical 1% to 1.5% annual management fee charged by active funds, the numbers get worse. The most important word in that data is consistent. It is not that active managers occasionally have bad years. It is that they underperform persistently, across market cycles, across bear markets and bull markets, across every time horizon that matters for retirement savings. The skill that justifies the fee does not exist at scale, and the specific lie is not that no active manager ever beats the market. Some do. The lie is that past performance identifies which managers will do so in the future. It does not. The managers who beat the market in one period are no more likely than chance to beat it in the next period. The ones who have beaten the market for 3 consecutive years are slightly less likely to beat it in year 4 than a randomly selected manager, because mean reversion is a more powerful force than any individual manager's skill. What to do instead? Low-cost index funds. A total market index fund with a 0.03% expense ratio, available from Vanguard, Fidelity, or Schwab, will outperform 88% of professional managers over 20 years before you do anything else. This is not a controversial finding. It is the most consistently replicated result in the entire history of investment research. Lie number 2. Diversification means owning lots of different things. Your advisor recommends a portfolio of 15 to 20 different mutual funds, each with a slightly different name, each covering a slightly different segment of the market. You feel diversified. You are paying fees on 15 to 20 separate funds. Here is the lie. Many of those funds hold the same underlying stocks. A large-cap growth fund and an S&P 500 index fund and a technology sector fund might have 70% overlap in their actual holdings. Buying all 3 does not triple your diversification. It triples your fees while barely changing your actual exposure. This is called diworsification, the practice of appearing diversified while actually just adding complexity and cost without reducing risk. And it is endemic in advisor-constructed retail portfolios because advisors are incentivized to recommend more products, not fewer. Each additional fund is another management fee, another potential commission, another layer of complexity that makes the relationship feel more valuable. True diversification is simpler and cheaper than the industry wants you to believe. 3 funds, a total U.S. market fund, a total international market fund, and a bond fund provide genuine exposure to thousands of companies across every sector and every geography. They cost a combined 0.05% to 0.10% per year. They outperform the 15-fund portfolio in most scenarios, specifically because the lower cost base compounds over time. The advisor who recommends 15 funds is not providing more diversification. They are providing more revenue for the funds and themselves. Lie number 3, you need to time the market. This one is subtler and more insidious. It rarely arrives as a direct statement. It arrives as a series of actions. Given current market conditions, we should rotate into defensive positions. With rates rising, we think it makes sense to reduce equity exposure. The economic data suggests we move to a more conservative allocation until things become clearer. Each statement sounds like sophisticated, forward-looking analysis. Each statement is implicitly claiming something that decades of research say is not achievable: the ability to predict where markets will go in the short term. The data on market timing is as clear as the data on active management. Missing the 10 best trading days in the market over a 20-year period, days that are impossible to predict in advance, reduces total returns by approximately 50%. Missing the 20 best days reduces returns by nearly 70%. And the best days in markets disproportionately occur during periods of high volatility and fear. Exactly the periods when market timing would have you out of the market. The investor who stayed fully invested in the S&P 500 for the 20 years from 2004 to 2024 earned approximately 10.2% per year. The investor who missed just the 10 best days earned 6.1%, the same starting capital, the same 20-year period. A difference of 4.1% per year, compounding every time an advisor suggests moving to cash, reducing equity exposure, or waiting for clarity. They are implicitly claiming an ability to time the market that the evidence says they do not have. And every time they act on that claim, they are increasing transaction costs, potential tax consequences, and the probability of missing the recovery that always follows the panic. Lie number 4, our fees are worth it. The financial advice industry has done an extraordinary job making fees feel small. It's just 1%. It's a small percentage. The value we provide far exceeds the cost. Here is what 1% actually costs over a lifetime. Imagine you invest $100 thousand at age 35 and earn an average of 7% per year until retirement at 65. With no advisory fee, that $100,000 grows to approximately $761,000. With a 1% annual advisory fee, reducing your net return to 6%, that same $100,000 grows to approximately $574. The 1% fee cost you $187,000, not 1%, not a small percentage. More than 25% of your final wealth, gone, in fees, and that is on one investment. Across an entire retirement portfolio of $500,000, a 1% fee over 30 years transfers approximately $935,000 from your retirement account to your advisor's firm. Nearly $1 million for the privilege of underperforming a low-cost index fund. The industry does not frame it this way. They show you the fee as a percentage of the current balance, not as a percentage of your final wealth. If they showed you the second number, most people would never pay it. Lie number 5, you need a complex plan. The financial services industry profits from complexity. The more complex your investment plan, the more products it requires, the more transactions it generates, the more advice it needs. Complexity is the product, but the evidence on what actually builds wealth is embarrassingly simple. Spend less than you earn. Automate the savings. Put them in low-cost, broadly diversified index funds. Increase the savings rate every time income increases. Don't touch it for decades. That is the plan. That is the entire plan. It fits in 5 sentences. It does not require 15 funds, a quarterly rebalancing meeting, a proprietary risk assessment model, or an annual fee that compounds into hundreds of thousands of dollars over a lifetime. The research on simple versus complex portfolios is consistent. The simple portfolio, 3 or 4 broad index funds rebalanced annually, outperforms the complex portfolio not despite its simplicity but because of it. Lower fees, fewer transactions, less opportunity for behavioral error. Less complexity means fewer decisions, means fewer chances for a human to do something that costs them money. The advisor who tells you that you need a complex plan is telling you that you need their services. That is a conflict of interest, not financial advice. Now, I want to add one genuine nuance before I finish, because not everything an advisor does is captured by these 5 lies. There are specific situations where a fee-only financial advisor, one who charges a flat fee or an hourly rate and takes no commissions, provides genuine value. Complex tax situations, estate planning, major financial transitions like divorce, inheritance, or business sale. The behavioral coaching function, someone who talks you out of panic selling during a crash, has documented value that is hard to quantify but real. The distinction is fee structure. A fee-only advisor paid by you, not by product commissions, has their incentives aligned with yours. They make more money when you are better served. A commission-based advisor makes more money when you buy more products. The same advice, delivered by these two people, has completely different reliability. The question to ask any financial advisor is not how much they charge. It is how they are compensated. If the answer involves words like commission, trail fee, fund revenue sharing, or any payment from the products they recommend, the advice you receive will be shaped by those incentives, not necessarily intentionally, but structurally and inevitably. The $17 billion a year that leaves American retirement accounts in conflicted advice costs is not the result of bad people. It is the result of a system where the incentives of the advisor and the interests of the client are structurally misaligned. And knowing that is the first step to making sure the $17 billion does not include your money. So here is where I want to hear from you. Have you ever felt like your financial advisor recommended something that seemed more beneficial to them than to you? Or do you think the complexity and personalization they offer is worth the cost? Drop it in the comments, because this is one of those topics where personal experience is worth more than any study.